Welcome to Motion and Means, the podcast that connects the dots between transportation and opportunity. Every journey, every route, every mode of transport we rely on isn't just about movement, it's about access. Access to jobs, to education, to community, to a better quality of life. Here on Motion and Means, we explore how transportation acts as a vital enabler, a true economic equalizer that can shape our communities and our individual futures. We'll look at the innovations driving change, the policies that can create more equitable systems, and the human stories behind the infrastructure. So let's get moving. This is Motion and Means. Today we are undertaking a really critical deep dive. We're looking at something that impacts, well, pretty much everything, supply chain volatility, as we head into the final quarter of 2025. And this isn't just about, container rates going up or down. This is about understanding the fundamental pressures that are reshaping how global commerce actually works. Okay, let's unpack this a bit. Our source material points to a profound structural dichotomy in the market right now. It's a central paradox, really. We've got rate deflation, these immediate sharp price drops smashing right into cost inflation. And that inflation, it's being driven by deep structural risks, long-term regulatory costs. So we need to figure out how these opposing forces are going to impact everything. I mean, from the cost of goods on the shelf right through to the future viability of the EV market, it's huge.
It absolutely is. It's a truly contradictory environment, and it demands a complete shift in how companies think strategically. Shippers might be seeing some tactical relief right now, celebrating these sinking freight rates, but the very foundation of global trade is shifting underneath them. Those fundamental operating costs, things like geopolitics, which we can't ignore, regulatory compliance, new tariffs, they're cementing a new, permanently high-risk baseline. So companies can't just focus on pure low-cost optimization anymore. It won't work. The focus really has to shift towards agility, towards resilience, and frankly, navigating complex policy compliance.
Okay, let's tackle the deflation side first then. Our sources are calling it the Great Container Rate Correction. Just how dramatic is this immediate price drop we're seeing?
Oh, it's dramatic. The correction is deep and it's been sustained. Spot container rates have actually been falling for 15 consecutive weeks now. We saw the Drewry World Container Index, the WCI, recently fall a full 8%. That puts it at just $1,761 per 40-foot container. That's a massive reversal from where we were.
Wow, 15 weeks straight. And are those drops kind of concentrated in specific areas, or are they hitting across the board on the critical roads?
They are really hitting the most important east-west lanes quite hard. Spot rates from Shanghai to Los Angeles, for example, dropped 10% down to $2,311. And that crucial Asia-Europe route, Shanghai to Rotterdam, fell 9%. It settled around $7,735. This sustained collapse, it really signals a deeply entrenched macroeconomic softness. Carriers, they're trying to manage supply, by blanking sailings, canceling trips. But the weak underlying demand is just overpowering those efforts.
Okay, but there is one potential bright spot, maybe.
Yeah.
Fuel costs are down. Global bunker fuel prices are apparently at their lowest point in about 52 months, hovering around $453 per metric ton. That should provide some relief for carriers, shouldn't it? Ease the pain a bit.
It absolutely should provide relief, yes. But, and this is the key thing, it's being neutralized, almost entirely overshadowed by those structural cost drivers we talked about. When you look at the bigger picture, the relief from cheaper fuel is just swamped by geopolitical instability. That instability is now the dominant, unshakable cost factor. What's really fascinating here, and maybe a bit alarming, is the sheer inefficiency it's forcing into the system. Think about this. Long-distance rerouting, primarily around the Cape of Good Hope because of issues in the Red Sea, has inflated what we call ton-miles growth to a record level, nearly 6%.
6%.
6%. Now, you need to stop and think about that number. The system is working almost 3 times harder ships, sailing much further, just to move basically the same amount of goods, because the actual global trade volume growth forecast for 2025, it's stalling out at just 0.5%. Tiny growth.
So right, we're talking about massive structural inefficiency then. The system is burning more fuel, taking longer just to maintain the status quo volume. But if the geopolitical situation, say, stabilizes, couldn't carriers just shift back to using the Suez Canal immediately and fix that?
Well, that's the million-dollar question, isn't it? That's the critical uncertainty. Right now, tonnage going through the Suez Canal is still 70% below 2023 levels. 70%. And this rerouting, it's looking less like a temporary blip and more like a persistent structural feature of global trade now. What this means, practically speaking, is that shippers must now budget for a permanent geopolitical risk premium heading into Q4 and beyond. And that premium isn't just about maybe paying a bit more. It includes longer lead times, higher insurance costs. It fundamentally raises the cost floor no matter how low fuel prices might drop.
Okay, so geopolitical risks are pushing up that structural cost floor. Let's pivot then and look at how immediate government policy is raising the, let's call it the complexity ceiling, particularly in the U.S. market. Our sources point to two immediate U.S. policy changes that are creating, well, it sounds like market volatility and some serious compliance headaches.
Yes, we're entering a radically new era of U.S. trade policy, and it absolutely introduces tremendous inflationary pressure, specifically on the compliance side of things. The first major change is the new tariff structure. Using the International Emergency Economic Powers Act, that's IEEPA, a baseline 10% tariff was introduced on all U.S. imports. That started back in April 2025. And on top of that, there are higher reciprocal tariffs being applied to shipments from countries that have the largest trade deficits with the U.S. So it's a huge baseline cost increase right off the bat.
10% baseline on everything. Wow. And the second policy shock, and this one sounds potentially even more disruptive day-to-day for logistics.
Yeah.
The suspension of the de minimis rule.
Correct. This is a big one, especially for e-commerce. Effective August 29, 2025, that long-standing $800 low-value shipment exemption, it was suspended for non-postal shipments. Gone.
Okay, break that down. What does the de minimis suspension mean for, for you, the listener, when you're shopping online, maybe buying something small from overseas?
It means every single one of those low-value e-commerce shipments, doesn't matter if it costs $20 to $200, doesn't matter where it came from, if it's shipped through non-postal networks like DHL, FedEx, UPS, it now requires formal customs classification and duty assessment. Every single one. Think about your holiday shopping habits, for instance. Before this, millions, probably billions, of small parcels just flew across borders with minimal paperwork because they were under that $800 threshold. That whole system of kind of automated, almost frictionless logistics for small items, it's effectively gone. This drastically increases handling time, cost, complexity, risk, everything for those massive e-commerce providers and logistics companies. It's an immediate and significant operational cost inflation factor kicking in right now for Q4. And it's forcing these companies to invest incredibly rapidly in automated duty collection systems, just trying to keep up with the sheer volume.
That sounds like a staggering operational hurdle, just the sheer volume of packages affected. Okay, the second major shock we're seeing hit U.S. consumption, according to our sources, is in the automotive sector. Specifically, the abrupt expiration of federal EV incentives.
Yeah, we're calling this the policy cliff.
Yeah.
And the source of this cliff is legislation called the OBBA, the Omnibus Bipartisan Budget Act. It basically stipulated that the $7,500 federal tax credit for new EVs and also the $4,000 credit for used EVs, they both expire suddenly. September 30, 2025. That was the cutoff.
And did this looming expiration date cause any sort of market distortions beforehand?
Oh, absolutely. A massive distortion. It triggered a huge, purely policy-driven sales frenzy back in Q3. Analysts were forecasting a record 410,000 EVs sold just in that quarter. Some experts are even predicting that September 2025, the last month before the cutoff, could go down as the single biggest EV sales month in history, simply because consumers rushed to claim that credit before it disappeared.
Right, pulling demand forward. So what does this aggressive pull forward mean for Q4 sales starting October 1st, now that the credits are gone?
Well, automakers aren't waiting to see. They're already slowing down EV production quite dramatically. They fully anticipate a sharp sales deceleration, a slump, and potentially a massive inventory buildup starting basically right now, right after that deadline passed. Now, the direct subsidy, that tax credit, it was replaced by something else, a less immediate incentive. It's a new auto loan interest deduction, allowing buyers to deduct up to $10,000 annually in interest payments. But this expiration, this cliff, it's really the pivotal moment. It tests whether the EV market can truly stand on its own fundamentals now, or if it remains structurally dependent on that kind of massive government support to drive sales. It's a huge test for the industry.
Okay, let's shift gears slightly now and look at the longer-term structural cost drivers. Things that aren't going away. Climate compliance. These regulations are global, they're tightening, and they're forcing monumental investment across the entire transport sector.
Exactly. Decarbonization isn't just an environmental goal anymore. It's become a hard financial imperative, and it's driven by critical regulatory deadlines that are hitting now. The most prominent one is probably the September 30th compliance deadline for the expansion of the EU emissions trading system, the ETS. That system now includes maritime shipping and aviation. Big change. And this is happening while, at the same time, the IMO, the International Maritime Organization, is maintaining those really ambitious global targets, aiming for net zero emissions by 2050, with a significant interim goal of a 40% emissions reduction by 2030. That's only a few years away.
40% by 2030. But fleet renewal, replacing old ships with new, greener ones, that takes decades. How are carriers managing compliance on their existing older ships right now? What's the stopgap solution?
That's precisely where technological retrofits become absolutely crucial. We're seeing OCCS, that stands for Onboard Carbon Capture Systems, emerging as probably the most viable interim compliance strategy for the existing global fleet. Our sources indicate these systems, when retrofitted, are capable of cutting up to maybe 19% of emissions from certain types of vessels. It's not perfect, but it's a vital retrofit solution needed to hit those 2030 targets without having to wait 20 years for the next generation of ships to come online.
Okay, so OCCS for ships. And what about aviation? The pressure there seems to be heavily on sustainable aviation fuels, or SAF. But these fuels are notoriously much more expensive than traditional jet fuel.
They are, and that cost gap is the major barrier. So governments are now stepping in directly to try and bridge that gap. A key example is the EU. They're allocating 100 million worth of those ETS allowances specifically to help airlines procure a SAF. And this marks a really key transition. It moves SAF sourcing away from being just a voluntary effort, something companies did for corporate social responsibility points, towards being a financially supported and increasingly mandated procurement activity for airlines. It's becoming a guaranteed structural cost baked into operations.
Right, so this entire environment we've discussed, the rerouting, the new tariffs, the climate mandates, it just screams for a massive technological upgrade across the whole logistics chain, doesn't it?
Right.
We see investment shifting towards things like AI orchestration, better data integration.
Exactly right. The focus is really shifting now. It's moving beyond just automating isolated tasks, like one part of a warehouse, towards achieving true system-wide digital interoperability. Everything needs to talk to everything else. We're seeing specific technologies being tested and deployed. For instance, prototype metro trains in Germany using CBTC, that's communications-based train control. They've been running autonomously after a year of successful trials. That's happening now. But the investment can't just be in the vehicles themselves. It needs to extend beyond that. With automated trucks already operating on highways in places like Texas, we're recognizing the absolute necessity of creating smart roads infrastructure that can facilitate real-time data exchange. And this confirms a core finding we see across the board. An autonomous vehicle, or any smart logistics system for that matter, is only ever as efficient or as safe as the infrastructure it communicates with. You need both pieces.
Yeah. Okay, so let's tie this all back together then, back to our original paradox. Rate deflation smashing against cost inflation. What does all this complexity mean for you, the listener, maybe running a business or just trying to understand where things are headed? How should the logistics sector be pivoting strategically in Q4?
Well, the key takeaway is that any tactical cost savings from those low spot container rates we discussed earlier, they are structurally unstable. They're transient. You can't build a strategy on them. The core strategic action required right now for Q4 and into 2026 is an immediate operational audit focused on U.S. trade exposure. Businesses need to understand exactly how the IEPA tariffs and, crucially, the suspension of the de minimis rule impact their specific supply chains. And beyond auditing, they must rapidly accelerate the utilization of tools like free trade zones, FTZs, and bonded warehousing strategies. These are now crucial policy hedges against this volatility and cost. And finally, if companies don't invest immediately in integrated data platforms, systems that can provide predictive alerts about disruptions or compliance changes, they simply won't survive this environment of chronic volatility. You need the visibility.
So it really demands a complete shift in mindset, doesn't it? Moving away from just chasing the lowest spot price towards prioritizing resilience, compliance, and, as you said, technological hedging. It's a different game. Okay, a final thought then for you to consider, maybe connecting this back to that idea of access and quality of life for the everyday consumer. If these new U.S. policies force importers to rely heavily on complex, potentially slower strategies like free trade zones just to manage duty costs, and if every single small international e-commerce package now requires a formal duty assessment, adding time and cost, how fundamentally will the speed and the cost of cross-border e-commerce change the nature of online retail for the average person? Is that convenience, that almost immediate access we've all gotten used to, is that about to take a permanent structural hit?
That is the ultimate question, isn't it? And it's the real test of the system's resilience as we close out 2025. It affects everyone.
Thank you for joining us for the deep dive.